Good morning, everyone, and welcome to today's session. Can you guys just let me know if you can hear me? Okay, excellent. So today we're going to continue with Learning Unit 6, which is Inventory Systems. This learning unit also forms part of your test in 2 weeks' time, so you need to pay special attention because I think because of the fact that they've asked a lot of perpetual inventory systems in your assignment, that in your test you can expect the periodic inventory system. Okay, this page is just to tell you where in the textbook you can find the information and the questions we are dealing with. On what page in your textbooks will you find the question information. Okay, so let's quickly look at what is the learning objectives for this specific learning unit. So the first thing is you need to be able to explain why some businesses choose not to use a perpetual inventory system, but a periodic inventory system instead. Calculate the cost of sales using a periodic inventory system. Demonstrate the working of the purchases and purchase returns account under a periodic inventory system. Demonstrate the working of the carrying on purchases and similar accounts that affect the calculation of cost of sales under a periodic inventory system. Analyze your inventory related transactions under accounting equation when using a periodic inventory system, and record the inventory related transactions in the subsidiary journals when using a periodic inventory system. And then explain which one of the two systems is the most desirable in the world we live in. Okay, so that's quite a mouthful. The biggest thing that you need to know for this learning unit is how to actually record the information using the periodic inventory system in your accounting equation as well as your subsidiary journals. So that means your cash journals, your credit journals, your general journal. And then also to know how to calculate the cost of sales in terms of the periodic inventory system. So those are the three things I would focus on when studying this learning unit. So what is inventory? Inventory are those assets that are held for sale or processed and sold or used in the production of another asset. Okay, so let's quickly look at my example there on the board. So what we hold for sale is, for example, we can hold the seeds for sale. So the seeds for lemons, we can actually, or oranges, we can actually hold them for sale and sell the seeds. We can alternatively also hold the oranges that we sell. What we can do is we can take the oranges and we can process them to make orange juice, which we then sell as another asset. So instead of the actual fresh fruit, we can convert it, use it in production, and then make something else. So then from that orange, we can take out the seeds, which we can use, we can plant them and then create an orange tree. Or alternatively, you can sell them as is, take the oranges and create orange juice. So those are just a few examples of what inventory is. Now you can see we get it in natural form or we get it in the processed form. Now, what the main thing is with inventory is remember that all the costs that we incur in creating that asset is capitalized if we've got a perpetual inventory system to the inventory account, but under the periodic inventory system, it is actually taken to the purchases account and the relevant expense account. So there are separate expense accounts, which we'll discuss separately a little bit. And that is the main difference when we talk about inventory. But inventory still remains the same thing when we look at the accounting equation. Okay, so this is the definition that was in Learning Unit 2 of your textbooks. Now, how is inventory initially measured? So initially measured means at the beginning. So when we start with this inventory, how do we measure it? The first time it is recorded in our accounting records. So we measure it at cost. So what did it physically cost me to acquire that inventory? So we include all costs that bring that trading inventory to its location, so that is where we are trading from, and for the condition required for sale. Okay, so that is very important to remember. Any cost that we incur to bring that asset to the location and the condition that is required to sell it is capitalized to inventory if we've got a perpetual inventory system. If we've got a periodic one, it will go to the purchases and the relevant expense accounts. Now let's quickly just recap what is the difference between the perpetual and the periodic inventory system. In this learning unit, we're going to focus on the periodic one, but don't forget about the perpetual one. They can still ask it. It's still part of the scope for the test, so you need to be prepared for both of them. Okay, so let's look at when we purchase inventory. When we purchase inventory under the perpetual inventory system, we debit our asset account, which is the inventory account, and we credit either bank or creditors control, depending on whether we acquired it for cash or credit. That is the perpetual inventory system. Under the periodic one, instead of debiting the inventory account, we actually debit the purchases account or the other expense account, whatever the name is. And that affects our owner's equity in our accounting equation. Okay, the second one is if we sell inventory. Under the perpetual inventory system, you have two double entries, while under the periodic one, we only have one. Now, under the perpetual, we've got one entry for the sale, so we debit our bank or debtors control, depending on whether we sold it for cash or credit, and we credit our sales. And then we also do one for the cost of sales. So we debit cost of sales, so what did it cost us, and we credit the inventory account. Whereas under the periodic inventory system, we debit either bank or debtors control, and we credit the sales account. You see that we do not account for the cost of sales under the periodic inventory system when we sell inventory, because we only record the cost of sales at year end when we've done the physical stock take. When we do the additional cost incurred in terms of the perpetual inventory system, whatever additional cost we incur, we take it to trading inventory, whereas under the periodic inventory system, we take it to the separate expense accounts. Now, those expense accounts are, for example, carriage on purchases, import duties, it can be storage, it can be any type of expense. They will name all the expenses and each one will go to their own individual expense account. Then number 4, trading inventory account. Now, under the perpetual inventory system, that trading inventory account will be a moving account. It will stay up to date. So we call it a just-in-time system. So I know exactly what is my balance at a specific point in time. Sorry, just excuse me for a moment. I just have to call my maid just to let someone in. Apologies about that. Okay, so let's just continue where we left off. Okay, so the trading inventory account under the perpetual inventory system is a working balance. So What it means is we know what the actual stock is at any point in time. Okay, so what that means is as we sell, as we purchase more inventory, we update the trading inventory account. Whereas under the periodic inventory system, that balance remains untouched. It is the opening balance right in the beginning of the year, and we only update the trading inventory account at the end of the year after we've done the stock take. Then cost of sales. Under your perpetual inventory system, we only record cost of sales when we sell the inventory. So that was part of point 2. So you do not record it again later on. Whereas under the periodic inventory system, we record it at year end once we've done the stock take and we can work out what is the cost of sales. Now we're going to look at how do we actually work out the cost of sales in terms of the periodic inventory system. Okay, so the following formula shows you exactly how to work out the cost of sales at year end under the periodic inventory system. So our starting point is you start with the opening trading inventory. Now I just mentioned that in terms of the periodic inventory system, that balance would not have changed from the beginning of the year. Okay, then we add purchases. Now those are all of whatever we purchased during the year, less any purchase returns. Now you will see we deduct the purchase returns, and the reason for that is we will have 2 separate accounts. We'll have a purchases account, we'll have a purchases return account. Then we add any carriage, railage, freight on purchases. Now you can see we add all of these other charges on there because they've got separate general ledger accounts. So we'll have a separate carriage on purchases or rail or freight, depending on how it was transported on purchases account. We'll have a separate import tariffs, a separate custom duties. So you add all of those expense accounts on, and then the last step is to deduct the closing inventory based on what we've determined based on the stock take. Okay, so that is how we calculate the cost of sales under the periodic inventory systems. Do you have any questions on how to calculate the cost of sales? Because we're going to do an example just now based on this. So if you've got questions, just ask me before we start the example. Any questions so far? Okay, then we'll move on. So the example that I'm giving you, so you can type your answer in the chat function or you can pick up your mic and explain it to me. This example is similar to what you find in the textbooks, but I want you to work it out for yourselves before we look at it. Okay, so Gentile Furniture's import an expensive lounge suite from Canada to be sold to a client in South Africa. The regular purchase price of the lounge suite is $30,000 before a trade discount of 5% was received. Other costs include transport cost inwards of 3,000 Rand and import duties of 1,500. The cost of trading inventory can be calculated as follows. So I want you to tell me, you can just type your calculation in the chat function for me. How would you calculate the cost of the trading inventory we acquired? What do I need to add all together to get to the amount? Okay, so how would you calculate the cost of the inventory we've purchased? Any takers? Okay, what is the first amount you would include to work out the cost? What is the first thing we paid for? You guys hear me because I'm getting no reaction on this question. Okay, so Lena said he took the 30,000, which is what our initial purchase price is. Then he multiplied it with 95%, so to take into consideration the trade discount. So he removed the trade discount. Then he added 3,000 Rand and he added the import duty of 1,500, and then he said we still need to deduct the closing trading inventory. Okay, so Lino, because we did not give you the closing inventory amount in this question, you could have left that out because we only purchased this item, but the way you explained it is correct. So let's just put it in a table format for everyone to see. So we start off with the purchase price. Now you can either do the purchase price less the trade discount in one step, or I've done it in two separate steps just to show you the thought process. So you start with the purchase price, the 30,000, then I deducted the trade discount, which was the 30,000 times 5%, which is 1,500, which gives you a net purchase price of 28,500. Okay, so that's similar to Lino's step one. Okay, then we add the transport cost, the 3,000 Rand, and we add the import duties of 1,500 Rand to get to the total cost of that inventory we've acquired, which would have been 33,000. Okay, so this is how we calculate the cost. Okay, now remember, any cost incurred after the product is at its location and the condition of sale will not be included in the cost of trading inventory. We will show it as a separate expense in our accounting record. So that is, for example, advertising cost, cost of storage before sale, that doesn't add to the product. Those things would be separate expenses in our accounting records. Okay, just in case they asked that, just to highlight it for you guys. Okay, now after we've recorded the inventory initially at cost, we then get to year end. So we call that subsequent or eventual reporting at reporting date. So that is our year end, when we have to create our financial statements. Then we do not necessarily record our inventory at cost. We look at what is the lower of the cost, so what did we actually pay, versus what is the net realizable value. Now the net realizable value is basically your market value. It is the selling price less any cost that I need to incur in order to sell that product to a third party. Okay? And that is what your net realizable value is. Now, if that is lower than the cost, then we actually record it to that. So we write it down to what the market value is, because some products would fluctuate in value. If your market value is more than your cost, then you leave it at the cost amount in our accounting records. Okay, Now, why do you think we do this at year end, that we write off the stock amount in our accounting records and our financials to the lower of these two amounts? You can type your answer in the chat function, or you can pick up the mic and answer if you feel more comfortable with that. So I'm just going to repeat the question. Why do you think at year end would we record our inventory at the lower of the cost and the net realizable value? Okay, so to answer things, to set a more realistic target or expectation. Okay, let me rephrase this. When we look at the financial statements, what was the characteristics, if you think back to Learning Unit 1, of our financial statements? What was one of the fundamental ones? You can page to your textbooks on page 9 to see if you can find the answer. Okay, so Nick said it needs to be relevant. So let's quickly read what it says. Information in the financial statement is relevant when it influences the economic decisions of the users. Okay, so it could be potentially relevance that it might influence the decision makers of the users. And then a part of that relevance and materiality is a component of relevance. If information is material, if it is omitted or misstated, could influence the economic decisions of the users. Okay? And then also we have to, if you look at the faithful representation, in order for financial statements to be useful to different users, it should be faithfully represent the financial performance, financial position, and cash flows of the reporting entity. This can be achieved by ensuring completeness, neutrality, and freedom of error. Now, the reason we write this down at year end to the lower of the two is to make sure that we do not overstate our assets in our financial statements by making it look a lot better than it actually is. Because like Nick said, it would be relevant, the relevance information, the materiality component of relevance. That is what would be the main thing that would be impacted. Nick, both would be correct, but the relevance would be the more accurate one of the two because of the fact that it is linked to the materiality component that would influence the decision makers of the users. So let's take an example. Let's say we purchase stock. Let's say we purchased machinery now, like cars, and when we acquired the cars at that stage cost 200 Rand a piece, or 200,000 a piece. We have 5 of them. So we've got R1 million worth of stock. But now at year end, a new car came into the market very similar to ours, which actually brought the price of our car down. So now instead of having a price of 200,000, we have to sell it at 150,000 in order to compete with our competitors in the market. Now, if I show that the assets I'm holding in my books is 1 million, when they're actually in fact at a lower value, it would potentially influence the decision makers' decision making because they would actually think that our assets that we hold is a lot higher than it actually is. So that's why we reduce it in order to show the users what the actual position of that business is at a specific point in time. Okay, so that is the main reason why it is the lower of the two. Now that subsequent event, you just need to know about it. This is generally more applicable to second year accounting, where they would focus on this information. Okay, when do you think is the risk and rewards transferred? Specifically when we look at trading inventory. So the risk is the risk associated with a specific inventory item, and the rewards is the compensation we receive. When do you think we transfer the risk and the rewards for a specific inventory item? Okay, so Tatu asked that I please elaborate. Okay, so my question, Tatu, is at what point in time when I sell inventory would I have transferred the risk? So risk, for example, would be theft, loss or damage to the products I'm selling. Where will I transfer that risk to the person I'm selling it to? And when will I be entitled to compensation for that product? So what do you guys think? At what point in time would I have transferred all the risks associated with that inventory to the third party? And when will I be entitled to compensation for that inventory? Okay, so Nick is asking, okay, so Tata says when it's sold, and Nick said, would the risk of a product fall into the buyer because it's not your product anymore, that you won't have to worry about it? Okay, so Tatu and Nick, the two of you are on the right track, yes. So normally the risk transfers to the third party on the date that I physically deliver it to them, okay? So when I've sold it, and then on that day, once they take ownership of that product, I can also get the reward. Now, in terms of accounting, we only account for the sale once the risk and rewards have been transferred to the different parties. Okay, so that means the person has taken ownership, the third party has taken ownership of these goods, and then I am entitled to the payment. So let's quickly look at what is the definition of a risk. The risk is when the business no longer needs to insure the goods against loss or damage or theft. Okay, so as soon as I don't have to worry about the products that it gets damaged or someone steals it, then I've transferred the risk to another party. Okay? Reward is when the business becomes entitled to receiving a payment for the delivery of the inventory. So let's take, for example, you buy something on Takealot. Until they give their package to you, Takealot still has the risk that if something happens to their delivery vehicle before it delivers it to you, they still have the risk to cover that losses. Once the package is delivered to you, so you receive the box from Takealot, they have transferred the risk So now if it gets stolen or damaged, it is no longer their risk, it is your risk. Okay? And as soon as you take ownership of that package, I am entitled to pay them. Okay, we normally pay them beforehand, so they collect their money before they actually deliver it, but they have not transferred the risk until they physically delivered the package to you. Okay. Now, because of how their system works, they collect the money upfront, but then you have 30 days to return the products as well for obligation free, and you get your money back. Okay. So this is what risk and rewards is. Okay, and this will be dependent on how the contract is stipulated. This is specifically very important when we talk about shipping. So let's say I ship something from overseas to South Africa. We get different types of shippings. We get free on board shipping point and a free on board destination. Now, free on board means as soon as it is on the ship, I have transferred the risk to the third party. Whereas free on board destination means I only transfer the risk once it arrives at the port or the destination where it was supposed to be delivered. Okay, so that is generally when, and consignment stock, normally we would only transfer the risk of consignment stock once the goods have been sold, because otherwise they can still return it. It's still my product. Okay, so this is what risk and rewards means. Do you guys have any questions on this before we move on? Any questions so far? Okay, so if it's free on board destination, so Nick is asking if it's free on board destination and something happens to your product, what would happen? Okay, so let's say it's free on board destination and pirates attack the ship and your shipment is stolen. Okay, it does happen, especially up in Africa. So what would happen is the company that sent the goods would be liable for the losses. So they would recover it from the insurance company and they would have to resend the goods again to their customer. Okay, so the customer will only take on the risk once the goods actually reaches the port. Okay, so that is the difference with free on board destination. Nick, does that answer your question? Okay, any other questions? Okay, so what we're going to do now is we're going to work through question 2.6. So it's in your textbooks. I'm going to put up the slide with the question on the next page. What I want you to do is for each of the following independent scenarios, indicate whether or not the item will be included in the cost of trading inventory for the vendor selling the goods in question. Okay, so you have to determine, will this be included, yes or no, in our cost? Okay, so I'm going to give you a few minutes to work through this and then we'll discuss it. Tatu, it's on page 192.